Earning money. When you start to work, you earning money for the work you do. Earnings can be worked out in different ways. You should understand some terms. Wage. Payment based on a set time at work, usually paid daily, weekly. Extra hours of work are called overtime, and these are paid at a higher rate. Salary. Fixed regular payment which is usually paid monthly to people in professional jobs. The salary is a fixed amount every year and does not change no matter how many hours you work. Commission. Payment based on the number of sales. The more you sell, the more you earn. Examples. Pay attention in these examples. They are self-explanatory. Deductions from earnings. When you are talking about incomes, it's important to understand the concepts of gross and net pay. Gross pay is the total amount a person earns before any deductions are made. Net pay is what's left after deductions have been made from gross pay. This is the amount an employee actually receives. Deductions can be made from wages for a variety of reasons. The most common ones that all employees receive are income tax, national insurance, private health insurance, direct debit for bills, retirement fund contributions. Total net pay is total gross pay minus total deductions. Example. Pay attention, this example is self-explanatory. Pay slips. Pay slips are the normal way of an employer to inform an employee of the amount the employee has earned. It lets you know that you have been paid. It gives you details of your basic wage, details of any additional money you have earned, and also shows you any money that has deducted at the end. Example. Mary's payslip is below. Can you show how to calculate his gross pay for the week and his net pay for the week? Gross pay is basic pay plus overtime pay. Basic pay, overtime pay. Add up both values to get the gross pay. Total deductions: tax deducted, NI deducted, retirement fund. Add up these values to get total deductions. Total net pay, total gross pay minus total deductions. Subtract these values. Income tax. Income tax is the tax people pay on the money that they earn. Typically, the first portion of income is not taxed. This is called your personal allowance. The rest of your salary above your allowance is called taxable income. This is the money your income tax is calculated on. Up to a given value of your taxable income will be charged at a basic rate of tax, and money over this will be subject to a higher rate of tax, and so on. Taxation of an individual's income is progressive. Example. Germany individual income tax rate 2018. Mr. Wolfmath earns 150,000 euros. How much tax will he pay in these years? First of all, find his tax bracket on the table. His income is in row 3 because it's between these values. He has tax of his earnings above 9,000 euros. So he has 141,000 euros of taxable income. The first value will be taxed at 14%. Calculate how much is left to be taxed. The second value will be taxed at 42%. Add up both values of tax. Brazil individual income tax rates 2018. This is personal allowance. Mr. Silvermouth earns 60,000 reals. How much tax will he pay in this year? First of all, find his tax bracket on the table. His income is in row 4 because it's between these values. He has tax of his earning above 22,848 reals. The first value will be taxed at 7.5%. Calculate how much is left to be taxed. The second value will be taxed at 15%. Calculate how much is left to be taxed. The third value will be taxed at 22.5%. Calculate how much is left to be taxed. The fourth value will be taxed at 27.5%. Add these values of tax.